You make extra repayments for months, then one morning the app says your minimum repayment has dropped. It feels like breathing room, but this video shows the trap before it quietly steals your progress. The bank has not handed you a prize. It has usually recalculated the smallest payment that still keeps your loan inside the contract. And of course, the lower number is tempting. In a normal Australian household, the mortgage competes with groceries, insurance, energy bills, kids, repairs, and every surprise that arrives at once. By the end, you will know the difference between the number the bank allows, the number that protects your goal, and the one setting to check tonight. Here is the reframe. Your minimum repayment is a floor. It is the least the lender asks for under the current calculation, not the payment that gets you debt-free fastest. When extra money goes into the loan, the balance used by the system can change. On some products, the app responds by lowering the scheduled minimum. But your old payment was doing work. It was not just covering this month. It was pushing more money through the loan while the balance was still large. That is the nudge. If you passively follow the new minimum down, your cash flow improves now, but your loan may lose some of the speed you worked to build. Choice 1 is to follow the new minimum. The vibe is relief. It can be sensible if the household genuinely needs breathing room after a hard season. The catch is time. You may still be paying correctly, but the loan can hang around longer than it would have if you kept the higher rhythm. Choice 2 is to keep the old amount. Same dollars leave the account, but now a bigger share can attack the loan because the required floor has moved lower. This choice feels boring because nothing dramatic changes in daily life. That is exactly why it works. The habit keeps going after the app changes the label. Choice 3 is to hold cash in an offset if your loan has one. The vibe is flexibility. The money can reduce interest while still staying easier to access. But offset is not magic. Some products charge package fees, some are partial offsets, and your actual scheduled payment still depends on your lender's rules. Redraw can feel similar, but it is different. That money has been paid into the loan, and access depends on the product rules, limits, and sometimes the bank's process. So the private question is this. Right now, does your household need lower pressure, faster mortgage freedom, or a cash buffer you can actually reach? The reason this matters is simple. Early in a long home loan, a big part of each minimum payment can be interest, not principal. A small monthly difference can look harmless in isolation. But mortgages repeat the same behavior again and again, so the habit matters more than the single notification. This is where people get caught. They celebrate the lower minimum as a saving when it may only be the bank letting them slow down without feeling it today. If you are on a fixed loan, be extra careful. Some fixed products limit extra repayments, and crossing the limit can create fees or awkward contract issues. Rate changes can muddy the signal too. A repayment can move because of extra repayments, a rate change, a redraw event, or the lender's own recalculation timetable. Step 1. Find the exact sentence in the notice. Is it a contractual minimum, a suggested payment, or your chosen direct debit amount? Step 2. Search your product document for redraw, additional payment, recalculate, and default payment. Boring words, useful clues. Step 3. If your goal is faster payoff, set the chosen amount on purpose. Old amount plus extra or new minimum. Just make it deliberate. The simple rule is this: the bank's minimum protects the contract. Your chosen payment protects the goal. Do not let the app decide which one matters more. If this helped map your thinking, subscribe. We put out one Australian household money guide every week.